Mastering investment accounting in hedge fund operations, strategies, challenges, and best practices. Investment accounting lies at the heart of hedge fund operations, serving as the backbone for accurate reporting, risk management, and strategic decision-making. As markets evolve and regulatory frameworks tighten, the role of precise investment accounting becomes increasingly critical for sustaining competitive advantage. Hedge funds operate in highly dynamic environments, relying heavily on sophisticated investment strategies and real-time financial data. Mastery of investment accounting ensures transparency, compliance, and efficient allocation of capital, a necessity for managing diverse portfolios across global markets. The evolution of investment accounting in modern finance. Historically, investment accounting focused primarily on tracking assets and liabilities within traditional investment vehicles such as mutual funds and pension schemes. Over decades, however, the rise of alternative investments, including private equity, venture capital, and structured products, has necessitated a redefinition of accounting methodologies. Modern hedge funds now manage intricate portfolios involving derivatives, leverage, and exotic instruments, requiring nuanced approaches to valuation, liquidity analysis, and performance attribution. This complexity demands robust systems capable of handling high-frequency trading, algorithmic strategies, and cross-border transactions. Leverage and margin requirements. Accurate accounting for borrowed capital and margin calls is vital to avoid overexposure and ensure solvency during market downturns. Derivatives and hedging instruments. Complex derivative contracts require meticulous documentation, fair value adjustments, and sensitivity analyses to reflect true portfolio risks. Cross-border transactions, currency fluctuations, tax treaties, and differing GAAP/IFRS standards complicate international investment accounting, demanding localized expertise. The increasing prevalence of ESG, environmental, social, governance, factors further complicates accounting processes, as funds must track sustainability metrics alongside financial returns. This dual focus requires integrating non-financial KPIs into traditional accounting frameworks. Fundamental principles of investment accounting. At its core, investment accounting adheres to generally accepted accounting principles, GAAP, and International Financial Reporting Standards, IFRS, but with significant adaptations for hedge fund structures. Key principles include accrual basis accounting, mark-to-market valuations, and thorough disclosure of off-balance sheet items. Accrual accounting ensures revenues and expenses are recorded when incurred rather than received or paid. This approach provides a clearer picture of a fund's ongoing profitability, even in volatile markets. For example, unrealized gains on securities held for sale must still be reflected in quarterly reports. Valuation techniques and their implications. Mark-to-market, MTM, valuations dominate investment accounting for liquid assets, providing up-to-the-minute reflections of asset values. However, illiquid assets such as private equity or real estate require alternative models like discounted cash flow, DCF, analysis or net asset value, NAV, calculations. The choice of valuation method impacts both investor perception and regulatory compliance. Inaccurate valuations can lead to misstated NAVs, triggering disputes with limited partners or penalties from regulators like the SEC. Transparency in methodology is therefore paramount. A recent study by PwC revealed that nearly 40% of investors consider valuation accuracy as the most critical factor in evaluating a hedge fund's operational integrity. This underscores the need for rigorous internal controls and third-party audits. To mitigate subjectivity, many institutions adopt standardized benchmarks. For instance, the use of NASDAQ indices for stock valuations or LIBOR-based rates for bond pricing enhances consistency across portfolios. Regulatory compliance and reporting obligations. Hedge funds face a labyrinth of regulatory requirements designed to protect investors and stabilize financial markets. Compliance with these mandates hinges on precise investment accounting records. Key regulators include the Securities and Exchange Commission, SEC, Commodity Futures Trading Commission, CFTC, and the Basel Committee on Banking Supervision. Under the U.S. Dodd-Frank Act, hedge funds must file Form PF with the SEC, disclosing details about their assets, leverage ratios, and risk exposures. Similarly, European Union directives impose strict MiFID2 reporting obligations, affecting transaction cost analysis and best execution policies. GIPS standards and investor trust. The Global Investment Performance Standards, GIPS, mandate uniformity in presenting fund performance. Adherence to GIPS not only ensures comparability across funds but also builds trust with institutional clients who rely on transparent data. GIPS-compliant reporting includes composite presentations, fee disclosures, and clear delineation of past performance versus current strategy. Failure to meet these standards can result in lost business opportunities, as institutional investors prioritize compliance-certified entities. Approximately 75% of global hedge funds report being GIPS compliant, according to a 2023 survey by CFA Institute. This reflects growing recognition of its role in fostering accountability and reducing informational asymmetry. Risk management integration in investment accounting. Efficacious investment accounting cannot exist in isolation from risk management protocols. By embedding risk parameters into daily accounting practices, hedge funds can preemptively identify vulnerabilities before they escalate into crises. Risk-adjusted return metrics such as Sharpe ratio and Sortino ratio demand seamless integration with accounting systems. For instance, volatility measurements derived from historical returns inform position sizing decisions, which in turn affect balance sheet classifications. Liquidity risk modeling relies on granular tracking of matured versus unexpired positions. A mismatch between inflows/outflows can trigger margin deficiencies, necessitating immediate intervention, and accurate accounting records serve as the foundation for rapid response. Stress testing scenarios simulate extreme market conditions, revealing gaps in current accounting assumptions. Regular updates to these tests ensure preparedness against unforeseen events like interest rate hikes or geopolitical shocks. Technology's role in streamlining investment accounting. Advancements in fintech have revolutionized investment accounting, enabling automated reconciliation, AI-driven anomaly detection, and blockchain-based audit trails. These innovations reduce human error, accelerate reporting cycles, and enhance data security. Cloud-based platforms facilitate real-time collaboration among auditors, custodians, and fund managers, eliminating siloed information. Tools like Bloomberg Terminal or FactSet integrate market data feeds directly into accounting workflows, minimizing manual input. Software solutions and their impact. Leading hedge funds utilize proprietary systems such as Aladdin by BlackRock or Advent Portfolio Management System to centralize financial data. These platforms offer modules for trade capture, settlement processing, and NAV calculation, critical functions in fast-paced markets. Machine learning algorithms now predict valuation shifts based on macroeconomic indicators, allowing proactive adjustments to portfolio allocations. Such predictive analytics were instrumental in mitigating losses during the 2020 pandemic crash. However, reliance on technology introduces cybersecurity concerns. A 2022 report indicated that 32% of financial institutions experienced breaches linked to insufficient encryption of accounting databases. Robust firewalls and multi-factor authentication are thus indispensable. Case study: navigating a market turbulence event in Q4 2022, a mid-sized hedge fund specializing in fixed income instruments faced a sudden yield curve inversion. Rapidly updating its investment accounting practices was pivotal in preserving client confidence and regulatory standing. By leveraging scenario analysis tools built into their accounting software, the firm recalibrated its duration risk exposure. This involved reclassifying long-duration bonds into shorter maturity equivalents, thereby lowering interest rate sensitivity. Transparent communication with LPs regarding adjusted NAVs prevented panic selling, demonstrating how sound accounting practices safeguard relationships during uncertainty. Post-crisis reviews highlighted the value of pre-established contingency plans. This experience reinforced the adage that preparation beats reaction. Effective investment accounting doesn't merely document financial reality, it shapes strategic responses to external pressures. Emerging trends shaping the future of investment accounting. As digital currencies gain traction, investment accounting must adapt to tokenize assets and record decentralized transactions. Cryptocurrencies present unique challenges, including price volatility, lack of centralized clearinghouses, and evolving legal status. The rise of ESG investing has compelled hedge funds to develop specialized accounting categories for green bonds, impact loans, and carbon credits. Tracking ESG metrics alongside traditional financial indicators adds layers of complexity to reporting frameworks. Quantum computing holds promise for solving optimization problems in investment accounting, although widespread implementation remains years away. Early-stage experiments suggest potential improvements in portfolio diversification algorithms. Ultimately, the future of investment accounting rests on agility, the ability to absorb technological changes, regulatory updates, and shifting investor expectations without compromising precision or speed. Conclusion: investment accounting is far more than number crunching. It is a strategic discipline that safeguards the financial health of hedge funds while aligning with investor expectations and regulatory demands. Professionals in this space must embrace continuous learning, remain vigilant about emerging threats, and invest in cutting-edge tools that elevate efficiency. Only then can they navigate the complexities of modern finance with confidence and competence.